Good afternoon, ladies and gentlemen. Thank you very much for sorry once again, back. I hope now you can hear me.
Unmuted.
Please tell me if you can hear. All right. Okay. Thank you very much. Okay. So welcome once again to this second session on IFRSs. Just give me 1 second. All right. Yes, so welcome to this second session on IFRSs and IASs. The last session on IFRS 15 was, I think, an excellent one in quite a few ways. First of all, it was such a huge session that there were quite a few learnings for us, from that session. I mean, there were about 1,600 people who had registered for the session.
Yes.
And for us to handle that kind of volume, we were not actually prepared for such a big volume. But now we've sort of thoroughly, discussed amongst ourselves what needs to be done to keep us on track, to make sure that we are able to cover the entire contents, to make sure that questions are handled appropriately.
Muted. Unmuted.
Is my audio?
Yeah.
What's wrong there? I'm alright.
Yeah. What is it?
No, it says voice issue.
It is working, sir.
Okay, all right. So, I thought that I was changes that we made to this session today ahead of the session, and then I'll repeat them also because there's still quite a few people who are joining. So first of all, what we decided to do is that we stick very, very religiously to the schedule. We have a lot of ground to cover. It would be appropriate for us to stick to the schedule. I request one thing on behalf of all of you also, that please do not send us questions as the lecture or as the session goes along. At appropriate points in time during the session, you will be given a break. In fact, a few minutes to type in your questions. Now, I would suggest that while the session is on, keep a paper and a pencil with you, and write down any question that comes to your mind while the session or while the lecture is on. Once we announce, the appropriate time for you to then start typing in the question. The reason for that is that a lot of our members try to preempt and preempt questions, whereas already on the agenda to be conveyed. No point in going to question in any case addressed during the session, but afterwards. So I think it will be appropriate if you just keep noting down your questions on a pad or on a piece of paper, and just as you're given it's announced time for you to type in your questions. That is when you punch them in. Now, what we do is we have to filter the questions ourselves also. Okay? So what we'll do is that questions that are related to the part of the lecture that have been delivered already. Right? only those will be answered. However, like last time, we are maintaining a log of all your questions also. So automatically after the session within due time, we will be able to send you all the answers once again the questions. Okay, so that will stay in record with you. So that was my first concern. We'll try to stick as much to the schedule as there's a lot of ground to be covered. Question and answers today during the session. Priority number 2 to us. Now secondly, I have to reiterate the fact that we are struggling with transparency and upholding the integrity of the CPD system. And therefore, last time we introduced questions during the session. Quite a few of the members took this initiative very positively, but a few of the members were not very happy about this. Now, our point of view on this is that we have to ensure there's a lot of effort that goes into delivering these sessions. I think top priority has to be learn as much from these sessions and not just watch for your CPD. I mean, that should be very low on your priority. If you're making good use of knowledge that being delivered to you, I can tell you this can go a long way. Professional development and career growth, and that's what he is committed to. I think if you have as priority, automatically everything fits in place. But if you're sort of concerned about units only, right? Then it becomes a bit of a question. So I suggest open it with us. It is in my knowledge that there are certain members, I don't want to name any, who have been misusing this, who have not been regularly or not been attending the entire session. Right? And therefore, on attentive. I would say it's a matter of giving respect to the trainer. I mean, all the trainers that we bring here, they are very senior in their roles. They work come here and speak with you. I think the excellent opportunity for you to avail rather than do all of the things that come your way as you're attending the session. So I hope you cooperate with us. I hope you will not make any of the last like he has been respond with questions and. I just thought this comment. Thank you very much, This is your first and last laugh. All right. Thank you very much, All right, now that's what I wanted to say. I understand as we deliver this session, there is a match that playing with match already started. Sorry, Australia. New Zealand. Match you're playing with Australia, over and run the Nova, sort of gives the possibility happens to be end of the match. So good luck, Pakistan cricket team. But good luck. Thank you all very much. Thank you all very much. I hope you'll enjoy the session.
Thank you very much, Mr. Assalamu alaikum, dear participants and members. And this is the continuity of the last session. So I would like to mention a couple of things which are important. So please keep a few things in mind. Number one, we will be covering a lot of aspects of financial instruments, but not 100%. So be patient, and your questions should be relevant to that aspects which is being discussed. So priority question will be, like if I am discussing something, then you should ask about the clarity or explanation of that matter instead of asking something which will be discussed later on. So this will help us in giving you a more beneficial presentations. And second is that I'll be announcing, so please don't start writing your questions while listening to me. I'll be telling you when you need to ask the question. You just keep a pen and copy with you, and you can keep on writing whatever question comes to your mind. So once I'll cover an appropriate part, so I'll be asking you to ask the question. At that point in time, maybe I have answered so many questions which you noted on your notebook. Only ask those questions which remains unanswered. Those questions which you ask, I may not be able to answer all those questions during this session. Those questions will be answered either through email or through messaging. So please be patient and remember what we decided right at the start of this session. So today's session is on financial instruments and International Accounting Standard 12. So we will be covering financial instrument in a non-traditional way. Non-traditional means I'll be discussing it in a practical way. First of all, what is financial instrument? So this definition we know from the standard. What is a financial instrument? A financial instrument is a contract that gives rise to a financial asset of one entity, and a financial liability or equity instrument of another entity. So this is financial instrument. On one side, it is financial asset of one party. On another side, either financial liability or equity instrument of another party. So we'll be looking at a lot of examples just to understand how it works. Then there is a small definition of financial instruments, small explanation. Financial instruments include primary instruments and derivative instruments. Derivative instrument that derives its value from the price or rate of an underlying item. For example, swaps, option. Derivative examples of derivatives are swaps, options, forward contracts, future contracts. All these derivatives derives their value from the price or rate of underlying item. So let's go back to the financial instrument. Examples of financial instruments. See, trade receivable. Trade receivable is a financial asset of one party, and this is a financial liability of another party. So there it will be termed as trade payables. Second, investment in shares. This is financial asset for one party, and equity shares of investee. This is equity instrument of another party. So I'll be giving you a lot of examples. So just remember these in your mind. These are only the financial instrument which we need to account for in our financial statements. Another example is holder of redeemable preference shares. Whoever bought redeemable preference shares, this is financial asset for that party. And the party who has issued these redeemable preference shares, this is financial liability for that party. Then is loan receivables, financial asset of one party. Loans payable, financial liability of another party. So I just want to give you a guess that there may be a question on it. So we may name some of these and ask you whether it is a financial asset or financial liability. Bond receivables, this is financial asset of one party, and bonds payable, financial liability of another party. Same instrument, but who bought it, it is financial asset for that party, and whoever issued it, it is financial liability for that party. Investment in redeemable preference shares. This is a financial asset, whoever invested in these shares. And the party who issued these redeemable preference share, this is equity instrument for that party. Similarly, finance lease receivables. This is a financial asset of the lessor. And finance lease obligation is the financial liability of the lessee. Similarly, there are few other examples, like in case of operating lease, individual receivable currently due and receivable. This is financial asset of the lessor. Operating lease, individual payments currently due and payable. This is financial liability of the lessee. Then if you have a deposit with a bank, this is your financial asset. And for bank, customer deposits are financial liability. For banks, customer deposits are financial liabilities. Similarly, a chain of contractual rights that will ultimately lead to the receipt of cash or to the acquisition of an equity instrument. I will repeat, a chain of contractual rights that will ultimately lead to the receipt of cash or to the acquisition of an equity instrument is a financial asset. A chain of contractual obligations that will ultimately lead to the payment of cash is a financial liability. Another example is a contingent right is a financial asset. A contingent obligation is a financial liability. So these were the examples of primary financial instruments. As we learned in the earlier slides, that there are two types of financial instruments: primary financial instruments and derivatives financial instruments. So let's have a few examples on that. If you are a buyer of an option which is in the money option means there are three categories. One is out of the money, one is in the money, the third is at the money. In the money option mean you will earn profit by exercising it immediately. So if this is the case, then that option will be your financial asset. And whoever wrote that option, that option is financial liability for the writer of that option. Similarly, if you entered into a forward contract, but that forward contract stands at gain, this is your financial asset. But if your forward contract stands at loss, then this is your financial liability. So these are financial instruments. For one party, it is financial asset. For another party, it will be either financial liability or equity instrument. So without looking at the standard definition, we'll be learning how to account for financial assets, financial liabilities, and similarly equity instruments. So there are certain instruments which are not financial instruments. So the key point is financial instrument is which give you present right to receive cash or another financial asset, or give you present obligation to deliver cash or another financial asset, and contractual in nature and not imposed by some statutory requirements. So these two are the key points in the financial instruments. So what we will discuss before I give you the detail what will be discussed. Let's see the scope. Certain items are excluded. from financial instrument standards, interest in subsidiaries, interest in associates, interest in joint ventures, pension and other post-retirement benefits, insurance contracts, contracts for contingent consideration in a business combination, contracts that require a payment based on climatic, geological or other physical variables, and financial instrument contracts and obligation under share-based payment transactions. So this is the scope. During this session, first we will discuss financial liabilities, then we will discuss financial assets, then we will discuss compound instruments, thereafter impairment of financial assets, and then hedging. So of course, this is not 100% of financial instruments, but if what we discuss about financial liabilities, if you have any question related to what we discussed, so please be relevant in that area. But if you have a question which is not related to a concept which is going to be discussed during this session, then you can ask that question through email or through other mediums. So first of all, let's discuss financial liability. Financial liability. See, I wrote subsequent measurement. Why I wrote subsequent measurement? Because its initial measurement depends on its subsequent measurement. So let's first discuss subsequent measurement. There are two options. One is you can subsequently measure your financial liability at fair value through profit or loss. But if they are held for trading or the entity so chooses, I mean, if your financial liability is held for trading, then you will have to measure it subsequently at fair value through profit or loss, or the entity so chooses. Otherwise, amortized cost. So what about initial measurement? Initial measurement at fair value, if subsequently it will be measured at fair value through profit or loss. Fair value less issue cost. This is important. If you subsequently measured that financial liability at amortized cost, then initially it will be measured at fair value less issue cost. This is the difference between this class subsequent measurement and this subsequent measurement. If subsequent measurement is at fair value through profit and loss, then initially it will be measured at fair value. But if you subsequently measure that financial liability at amortized cost, then initially it will be measured at fair value less issue cost. So let's understand with the help of an example. This illustration is available with you. We made it available for you because I may be moving to the answer so that it should be in front of you. For example, this is illustration number 1. I hope you have received this, and if not received, I think this is uploaded in this webinar. You can access to this handout number 1. So this is handout number 1. A company raises finance by issuing 20,000 6% 4-year loan notes on the first day of the current accounting period. The loan notes are issued at a discount of 10% and will be redeemed after 4 years at a premium of 1015. So I'll take the help of pen here just to explain you few terms. The issue cost were $1,000 required. Explain and illustrate how the loan is accounted for in the financial statements of the company. before we go to the accounting treatment, we need to understand certain things. For example, this 20,000 is termed as face value or nominal value. Nominal value. I hope you can see what I am writing. Bilal, is it clear?
Yeah, it's clear.
Okay. Face value or nominal value. And what is this? This is 6%. This 6% will be termed as coupon rate of interest, coupon rate of interest. So this is discount. Discount is the normal term. If you issue a loan having a face value of 20,000 at 10% discount, this means you received 18,000. 10% discount means 10% of 20,000, 2,000 discount. So you received, cash received is 20,000. Sorry, cash received is 18,000 after discount. Face value was 20,000 of this loan. You issued it at a discount. So discount is a very general term. 10% discount means 10% of the, like a list price, like here in this case, it is 10% of the face value. So you received cash 18,000. And you will be redeeming this loan at a premium of 1015. What does it mean? Premium is always added to the face value. This means at the end of this, at the end of the term, you will be paying to the holder 21015. Mean 20,000 plus 1015. 20,000 face value plus 1015. So what we concluded, you issued a loan with a face value of 20,000, but you issued it at discount. This means you pocketed 18,000 and you committed that this will be redeemed at a premium. Premium is normally on the face value. So how much you will be paying? 20,000 plus premium, mean 21,015. Then they have provided us the effective rate of interest is 12%. Effective interest rate. So this can be termed as like market interest rate or like this. So this is the whole question. So what we learned from the last slide, that, so I think it is, let me go to the Word document. So question is in front of you. So I think some technical issues. Let me go to the Word document.
Stuck again. PowerPoint stuck. PowerPoint stuck. Actually, no, application ठीक है. Restart करना PowerPoint. So can we close
no
some
problem.
of these.
No problem.
IAS उसकी वजह से स्टॉक हो रहा है.
इसके वजह से ये बात
ये हैंड आउट से ज़्यादा
वो बंद कर दें. ये 6 ये जो 6 हैं ये
जी.
एक से ये सारा
Yeah, open up the presentation.
of science. Yeah.
In the meanwhile, if you could answer some questions.
Yes, please. Yes,
For
please.
example, what is the difference between market rate and effective interest rate? What is the difference between market rate and effective interest rate?
Same. Same. So now it is working?
Yeah.
So I'll be telling you when questions should be answered. Inshallah, I'll be giving you the time. Okay. So we were on this question. We read this question. We are on it.
Yes.
We are live. Okay. So this was the question. So in this question, initial measurement. What we learned about initial measurement, because this will be subsequently measured at amortized cost. So initially it will be measured at fair value minus issue cost. So what is fair value? Here issue cost is 1,000. This is given in the question. And the fair value is cash received excluding issue cost. So this is 18,000 after a discount of 10. So we will initially measure it at 17,000. What is the face value? Face value we know, or nominal value is $20,000. Dollar or whatever currency is there. So 17,000 we will initially measure it. So this is the concept of the initial measurement. So now, how we will treat later on? So if we just make a small table, so there will be opening liability. So what is the opening liability? We measured this opening liability at 17,000. So this is year or period 1. This is the opening liability, 17,000. So at the end of the year 1, this liability will increase by how much? This will be increased by the amount of finance cost. So finance cost will be calculated by multiplying this opening liability with the effective interest rate. So this is the finance cost which will be charged to the profit and loss account as a finance cost. Then cash paid. So normally cash paid is either interest or capital. In first year, interest is paid. How this interest was calculated? This interest was calculated by multiplying the coupon rate with face value. This is the formula for the calculation of actual cash payment. Actual cash payment will not become your finance cost. So please remember, finance cost will be calculated by multiplying the opening liability. This is the opening liability with the effective interest rate. When you will multiply these two figures, so you will reach finance cost for that year or that period. So how much cash is paid? That will be calculated by multiplying the coupon rate with the face value. So then after taking into account these two elements, we will be calculating closing liability. See, the formula is very simple. Opening liability, finance cost will result in the addition of this liability. But any cash payment will reduce this financial liability. So if we just take the help of a calculator, for example, here effective interest rate is 12%. Then 17,000 into 12%. This is your finance cost, 2040. How I calculate it? 17,000 into 12%. So this is your finance cost. Then cash paid, coupon rate is 6% as given in your question, and face value is 20,000. So this will become 1200. So 1200 is the cash paid, and this is increase in the liability, which is finance cost. So 17,000 plus 2040 finance cost minus cash paid, this will give you the closing liability 17840. This will appear in the statement of financial position. So this is opening liability. I just repeat, and then we will move to the answer of this illustration. This is opening liability. How we calculate it? We calculate it using the guideline from the standard, which says that this will be initially measured. This will be initially measured at fair value less issue cost. Fair value is cash received without including the effect of issue cost. So cash received is 20,000 minus 10% discount, 18,000 fair value minus 1,000. So we initially measured at 17,000. So this was our opening liability. This was our opening liability. Then at the end of the year, we calculated the finance cost by multiplying simply this opening liability with the effective interest rate. So thereafter, we will calculate how much cash we have paid. That will be calculated as per the information given in the question, but normally this will be coupon rate of interest into face value. Why I say you should look at the question for this information? Why? Because sometime we will be discussing a situation very briefly. Sometime you entered into an agreement with the bank for rescheduling of your loan. So there may be change in the interest rate. There may be change in the cash being paid or the timing of cash being paid to the bank. So this column is for cash paid is actual cash paid. So normally it is, if there is no rescheduling of the loan, normally it is originally agreed coupon rate of interest into the face value. So we will reduce this liability with this amount. So closing liability will be 17840. So at the end of year 1, in the statement of financial position, 17840 will appear as a closing liability. So this is the way of accounting for financial liabilities. So let's see the solution of this example. So the solution of this example is, see here it is a solution. So let me expand it so that you could view it very easily. So this was our opening balance, 17,000. This is finance cost, this is cash paid, so this is closing liability. This closing liability will become the opening liability of year 2. So now finance cost will be calculated by multiplying 17840 with 12%. So this is cash paid, no change. So by adding these two and deducting 1200, the closing liability 18781. Similarly in year 3 and similarly in year 4, you can note that in year 4 you paid interest as well as the principal amount. And we learned from the question, you were required to pay, just please refer to the illustration number 1, which is available in handout number 1. So that is 20,000 plus premium of 1015. So this will make it 21,015. So this will make it nil. So this is the way you treat the financial liability. So this last column is the closing balance of the financial liability, which will appear in the statement of financial position of respective year, and this is the finance cost which will be charged to the profit and loss account of the respective year. So this is the way of this is the accounting of the financial liability. So this was the illustration number 1. So Mr. Harun, can you help me if there is any question so far, because I have discussed one area.
Okay, have you given them the question answer break? Can they type in their questions now?
Yes, please type in your question. You have 1 minute. So type your question if you have any question regarding what I discussed.
Sahar Amin has one question. She's asking, kindly elaborate the effect of. Okay, so the question is pouring in now. Kindly elaborate the effect of premium of 1015.
Premium of 1015. So this is the amount which the company agrees to pay when this liability will be redeemed. So they will be paying more. When you say it will be redeemed at premium, this means you will be paying 1015 over and above 20,000. Over and above normally face value. Thank you.
Next is from Sidra Haq. She's asking, if effective interest rate is not mentioned in specific, how can we distinguish it from coupon rate?
Coupon rate is normally mentioned with the loan face value. If effective rate is not given, so the question of differentiating does not arise.
Next is from Sabika Ansari. She's asking, please mention the double entry of this illustration.
Double entry of this illustration? Yeah. Just for year 1, for example. For year 1, the double entry will be, for year 1, let me use here the pen. For year 1, actually you paid how much? You paid cash. Fine? Mean credit cash. For year 1, let me use another, let me use another color. I would say, yes, green. No, sorry. So credit cash, because you have paid how much? 1200. I am just talking about year 1. You have paid 1200. Debit finance cost. Finance cost in the profit and loss account. How much? 2040. So what about the remaining amount? Balancing figure will go to the financial liability. So what is that? The difference between these two. The difference is, I hope it is 840. So this is the double entry for year 1. Similarly, you will be making entry for year 2, year 3, year 4. Cash credit, how much cash you have paid, that will be credited. Finance cost, of course, this column will be debited because this is an expense. The balancing figure will go to the financial liability.
Next is from Salman Rafiq. He's asking, how about tax liability? It's imposed by law or is it a financial instrument?
It is not financial instrument because it is imposed by law. It is not contractual in nature.
Next is from Rehan Siddiqui. How did we knew that we have to measure initially at amortized cost in illustration 1?
Yes. This illustration was specifically meant for amortized cost, but it was specifically meant. Otherwise, it is given in the requirement or additional information is required for that purpose.
Next is from Sheikh Nabil Tahir. Please explain how effective interest rates are calculated, like 12% comes how?
This is market interest rate. This is calculated by discounting all the future cash flows attached. This is the discount rate which will make the NPV 0. This is the IRR of all the cash flows attached with that instrument. And this is, you can name it as market interest rate as well. Yes, please.
Next is from Sikandar Khan. What is the difference of primary and derivative instruments? Examples of primary instruments.
There are many primary instruments like account receivable, account payable. Account receivable, see, go to the slide. In this slide, if you just look at the first 2 slides, all these are examples. These are the examples. I hope you can see this slide. This is the primary instrument. This is again primary instrument. Very few derivative instrument. These are 2 examples of here in this slide. I hope you people can see this slide. This slide. So this slide includes the example of derivatives instrument.
Next is from Rabia Wapiwala. She's asking, kindly explain the reschedule part again and the treatment for that.
Yes, we'll be discussing in the later illustration. This will be discussed.
The recording will be available hoga wahan se lijiyega.
Okay.
Next is from Imran Sarmar. How this liability is treated in SOFP when measuring initially at FVTPL?
Initially, only if we treat this financial liability being subsequently measured at fair value through profit and loss account, so we might have recognized it initially at 18,000. Yes, please.
Muhammad Arif Javed is asking, sometimes if effective interest rate is not given, should we use IRR there?
Yes.
Gurrez Raza is asking, when calculating cash paid, we use coupon rate X face value and we use 20,000 figure. Why did we not use the net of discounted figure, that is 18,000?
Interest is always paid on face value. So that's why we used. Interest is always paid on face value.
Javedia Aruj is asking, how can effective interest rate be calculated?
Effective interest rate, this is the repetition of question. You can check it from the recording as well.
Valam Pikai is asking, could EIR and coupon rate be same?
Yes, it could be.
Fasih Khan is asking, what are the out of the money and the money options?
Money option,
What are the out of the money and add the money option?
Out of the money, if you exercise that option, you will be making a loss. So this option will be termed as out of the money. If you will end up with no profit, no loss, so this will be termed as option add the money.
Next is from Mehdi Hussain. What will be the effect on this liability calculation if the effective interest rate change? Suppose in the case of loan interest rate is revised.
So we are going to discuss. So this means repetition start, and now you people started asking questions related to what I am going to discuss, like rescheduling, like if there is any change in the terms and conditions and things like this. So amortized cost. So remember one thing before I move further. If a financial liability is subsequently measured at amortized cost, then original effective interest rate will not change. Please note it. See, every year there may be a change in the market interest rate, but your finance cost will be calculated using the same effective interest rate which stood at the date of inception. So let's move to another practical example. So please be attentive. This is available with you. So this is practical example in which there is some change. See, on 1st January 2009, ZPL had obtained a bank loan of 100 million at 10% per annum. The interest was payable annually on 31st December and principal amount was repayable in 5 equal annual installments commencing from 31st December 2009. On 1st January 2011, the bank agreed to facilitate ZPL as follows. Balance amount of the principal would be paid at the end. Now this is rescheduling. Till 31st December 2010. No change. From 1st January 2011, there was a change. There was a rescheduling. Balance of the principal amount would be paid at the end of the loan term on 31st December 2013. And with effect from 1st January 2011, interest would be paid at the rate of 10.5% per annum. The market rate for the similar debt is 10%. This is effective interest rate. So what is required? Required is accounting treatment for the above financial liability. So how we will treat? First question is, like, this question is in front of you. So let me go to the word so that I could explain it. See, in this question, the initial liability is, initial measurement is, that is 100 million. You received from the bank, initial measurement 100 million. So let's select from here the pen. So this is 100 million. Opening, so this is 2009. Opening liability is 100 million. So this is initial measurement. So at the end of 2009, we need to calculate the finance cost. How we will be calculating the finance cost? By multiplying this opening liability with the effective interest rate, which is 10%. So this will become 10 million. So how much cash paid? We know two types of cash payments could be there. One is interest, other is principal. Here in this case, if you just go back to the question, you can see that in this question, the examiner is saying, the writer of this question is saying, rather I would say, see, interest was payable annually on 31st December and principal amount was repayable in 5 equal annual installment. So 5 equal annual installment means in the first year, 1/5 of this you have paid plus the interest. In the first year, how much you paid? In the first year you paid 20 million plus 10 million. Here coupon rate of interest and effective interest rate are same. So you paid 30 million. So the same formula, how to calculate the closing liability? Simply add these two, 100 plus 10, 110 minus 30. So this will become 80 million. Likewise in 2010, 80 million become opening liability. Again, finance cost will be calculated by multiplying this opening balance with the effective interest rate, which is 10%. So this will become 8 million. How much you paid? Again, 20 million. Because it is mentioned in the question. I am referring to the question again and again. See, it is written here, repayable in 5 equal annual installment. 5 equal annual installment mean 100 million will be divided into the 5 installment, 20 million each, plus the interest. So in this case, 20 million capital repayment and interest is on 8 million. Why same? Because here the coupon rate of interest, face value and the fair value both are same. So this will become 28 million. So when you deduct 80 million plus 8 minus 28, so this will give you the 60 million. So this is your balance. Now 2011. At the start of 2011 there is a change, there is a rescheduling. What is the change? Change is two things. One, interest. It will be paid now at the rate of 10.5%. Please refer to the question. Refer to the question. Line number 6, balance amount of the principal, line number 6, 7, 8. With effect from 1st January 2011, interest would be paid at the rate of 10.5%. So 10.5%. So, and what about capital repayment? Capital repayment, there will be only one capital repayment. When? At the end of the term. At the end of the term mean 2009, 10, 11, 12, 13. Yes, 13. They will be paying this 60 million when? On 31st December 2013. So this is the term. So what we will do? This is important. So here on right at the start this is changing. What we will do? Please listen carefully. We will calculate the value of this financial liability. Sorry, I think I should go down. Okay, here. We shall calculate. Let me go up. We were here. Yes. Yes. So how I will calculate? I will calculate. Yes. On 1st January 2011, I need to recalculate the opening liability. So how I will do? I will see what are the future cash flows. What are the future cash flows? Future cash flows are in 2011, at the end of 2011, interest will be paid. How much? 10.5% of 60 million. How much interest will be paid? 60 million. So this will make it 10.5% into 60. So this will make it 6.3. Hope so. So let me check it again. 60 into 10.5%, 6.3. This is one future cash flow. Other future cash flow in 2012, again 6.3, and in 2013, 6.3 plus 60, capital repayment. So these are the cash flows, 6.3, 6.3, and then this is 66.3. So please excuse me if there is any problem in the calculation. Anyway, we will be looking at the proposed solution as well. So that will, so you should have calculator with you as well, so that you could help me as well if there is any problem in the calculation. So what is the discount factor? So you will calculate the present value of these future cash flows using the discount rate, which is 10%. So when we'll be multiplying, so this will give us the present value. So this amount, which will be the addition of these two, this is the revised financial liability as a result of change, rescheduling or change in terms. So you will be calculating yourself. I will be showing you in a while. Meanwhile, you can calculate. Just multiply 6.3 with this factor, 6.3 with this factor, 66.3 with this factor, then add all these three figures. This will become the revised financial liability. Now, what is the liability available with us? The liability, so let me go up. So, at the start of 2011, the liability is 60 million. The liability is 60 million. This is the liability. This is the liability. This is the liability at the start of 60 million. But now there is a change. Something, maybe 60 million plus. So the difference between these two will go to the profit and loss. So, I hope you understand. I'll just repeat. In 2009, we did the same as we did in the earlier illustration. This is the initial measurement. There is no discount, so 100 million we received from the bank. So this is the finance cost based on the effective interest. Here, effective interest rate and the coupon rate are same. Both are 10% in 2009 and 2010 at least. So 10 million. Then, as per the terms, at the end of first year we paid 20 million as a capital repayment and 10 million related to the interest. So closing liability will become 80 million. Then 2010, 80 million, 8 million likewise. So at the end of 2010, this was 60 million. At the start of 2011, this was 60 million. But right at that point, we renegotiated with the bank and there was a change in the terms. What was the change? Now bank will be charging interest rate at the rate of 10.5%. This means now future cash flow will be based on this rate. Future cash flow will be based on this rate. And capital, previously we were paying every year a small amount of capital, but now the whole amount, the whole outstanding capital will be repaid at the end of the 2013. So this is the change. So what we did, we need to recalculate the financial liability at the start of 2011 as a result of this change. What we did, we just note down here as a result of this change, what will be the future cash flows. We discounted those future cash flows using the effective interest rate, and this gave us revised financial liability as a result of this change. So the difference between this revised financial liability and the financial liability of 60 million at the start of 2011 will be charged to the profit and loss account. So let's see the standard solution. See, this is the question, I think. Yes, this is the question. So let's go to its solution. So the same 80 million, this is the opening balance, this is the finance charge, this is the cash paid, which we know is 20 million plus 10 million of interest. Here 20 million of capital repayment, 8 million of interest. Then there is a change. This 60 million become 60.7461. What we did, we passed this entry. We passed the entry that on 1st January, when this change took place, profit and loss account debit 746,000 and loan account, mean financial liability 746. There is an increase in the financial liability from 60 to 60.746 million. So the difference is charged to the profit and loss account. Thereafter, see, on 2011, this will be the entry. Thereafter, simply again finance charge. This will be again on the basis of effective interest rate. So here there is a small correction. It should be 6.074 instead of 60.4. It should be so. This is the correct. So 6.3 is the cash paid. 60 points. So this is the closing liability. Likewise, in year 2012 and year 2013, Now this is the actual cash paid. This column will always be for actual cash paid. Initially, this was the cash amount. After change in term, this is the cash amount. But this will remain on the effective interest rate. So in 2013, the closing balance is nil. So this is our another illustration. So let's go back to our slides. So this was illustration number 2. So this fully explained the method for amortized cost, even if there is a change. Now let's have a look at when you subsequently measure your financial liability fair value through profit and loss. So we will understand it with the help of illustration number 2. Illustration number 2 is available with you. So if there are any question which can be answered at this point in time, so just because we covered one section, so that we could move further. I think we can pop up at least 2 questions at this point in time. So there are 2 questions to be asked. Meanwhile, you can...
they can type in their questions. All
Yes.
the ones that are not answered, they don't need to worry.
Yes.
I mean, the final question answered,
Yes, yes.
all the questions will be answered there.
Yes.
All right, so I'll just pick up 2 questions. So for example, one is by Asmatullah saying, if, and questions are started pouring in again, if there are significant changes to the terms of a loan, will it not result in derecognition of the current loan agreement and recognition of the new loan agreement?
Very right. We are going to discuss this.
Okay. Why there is a need to calculate revised financial liabilities, Amin?
Because there are changes in the terms. There are changes in the terms of the financial liability. Rescheduling, yes.
Yeah, all the questions asking for us to redo certain concepts. I think it would be best that they can watch the video in which they'll be able to repeat the concept. Yes. As per the last example, this is Bilal Mustafa. As per the last example, please clarify as there will be no short-term liability pertaining to loan which will appear in the balance sheet.
Yes, of course. The closing liability, which is mentioned at each year end, that will be divided into current and long term.
Okay. Poonam Nadir is saying, can you please elaborate the entry at the time of revision?
At the time of revision. The difference between the financial liability before the revision and the financial liability as a result of revision, that will be charged to the profit and loss account. How you will charge? If it is increase in the liability, debit profit and loss account, credit financial liability. If it is a decrease in the financial liability, debit financial liability, credit profit and loss account.
Okay, I think the last question by Hafiz Abdul Miraj. In ZPL example, coupon rate was changed to 10.5%.
Yes.
But the EIR remains the same as 10%.
Yes.
Correct me if I'm wrong.
He's right.
He's right. Thank you very much. I think that's all. Let's move on.
Can we take some?
Can you please pop up 2 questions at least?
Okay. So
Please pop up 2 questions.
the pop-up question I thought.
Yes, yes. Yes, I mentioned actually pop-up question. Anyway, no problem.
All right. Okay. 4 questions. All right. Let me once again state this to all of you that pop questions are very, very important to be answered. Okay. We are not checking the correctness of your answer at this stage. We are just checking whether you are responsive or not. So everyone on the call, and there are about 400 people on this webinar right now, we would expect everyone to answer this first pop-up question. Now, the pop-up question or the poll question will appear on your screen in a bit. After that, you will be given 1 minute to answer the question, and then we will share the answer. After that 1 minute, we'll share the answer with all of you. So the question appears on your screen now. The question is, forward contract standing at gain is an example of financial asset. Please select one, yes or no. So all you have to do is click yes or click no. You have 1 minute to answer this question. 30 seconds left. $15. 5, 4, 3, 2, 1, and 0. Okay. Let's see what the participants have mentioned.
Yes, okay.
So I'm going to share the results with you. So 91% have said that the answer is yes.
I'm happy to see this because this means they are with us right from the start of this session.
Excellent, but there are about 9% who say no. But that's it. So the right answer is yes.
Maybe the effect of the match.
Yeah.
Okay. So can you please pop up another question?
All right. Are you all set for the next question? So it comes on your screen now. And once again, you have a minute to respond. The question is, these are derivatives. The first set is swaps, options, and convertible bonds. The second set is future contracts, options, and swaps. $30 seconds mark.
%.
15. 5, 4, 3, 2, 1, and 0.
72%.
Yeah. All right. So I'm going to share the results with you. 17% thought that the first one was the right option, which was swaps, options, and convertible bonds. But 83% thought that future contracts, options, and swaps was the right option.
83% were correct.
Exactly. All right. So
I gave 4 examples of derivatives: swaps, options, forward contracts, and future contracts.
Excellent. Excellent. So 17% are probably enjoying the match also, but then, I mean, it was not about the correctness. Thank you very much. You've been very active. We are resuming the session now.
So now we'll understand about the fair value method. So I think I can...
When are we going to have a break? We started at 3 o'clock. It's 4:10 right now. Do we have a break or we don't have a break?
Yes, we have. We may or may not. I cannot say right.
Okay,
this is illustration number 2. On 1st January, A Limited issued 3-year 5% 30,000 loans notes at nominal value. Nominal value means no discount, no premium. They issued at 30,000, face value was 30,000 and they received 30,000. When the effective rate of interest is also 5%. The loan notes will be redeemed at par. The liability is classified at fair value through profit and loss. At the end of the first accounting period, market interest rates have risen. Required. Explain and illustrate how the loan is accounted for in the financial statement of A Limited in the year ended 31st December 2011. So this is the first year. See, the first question is, let me go to my worksheet. Okay, so this is my worksheet. So here we go. Okay. So here, first of all, I'll be recognizing it initially. So this is 2011, the same way. This is the year. 2011. What is the opening liability? Same. A lot of working is a mirror image of as we did for the amortized cost. Opening liability So this will be how much? This is the initial measurement. This will be measured at fair value, because this will be subsequently measured at fair value through profit and loss. So this will be measured without deducting any issue cost. Anyway, no issue cost is provided. Had it been there, we would not have deducted that issue cost in arriving at this amount for initial measurement. So initially, this will be measured at 30,000 because there is no discount. So the face value is 30,000 and this was issued at 30,000. Finance cost. I hope the same principle. Finance cost will go to the profit and loss account. So the same principle, effective interest rate into opening liability. I am naming it OL, opening liability. So effective interest rate is also 5%. Opening liability is 30,000 in this case, 30,000. So this will make it 30,000 into 5%. So this will make it 1,500. So this is finance cost. Cash paid. So we remember from last two illustration, cash is always paid on coupon rate of interest, actual cash paid. That cash will be paid on coupon rate of interest. Coupon rate of interest is 5% here. And this will be paid on the face value. Here the face value and the cash received are same. So that's why 5% into 30,000, cash paid is also 1,500. So closing liability will become 30,000. But please remember here, this figure will not go to statement of financial position. Whereas in case of amortized cost, this was the amount which used to go to the statement of financial position. What we will do now, we will see at this point in time, which is 31st December 2011, what is the fair value of this financial liability. So be careful how we will calculate the fair value. We will calculate the fair value. First of all, we will see what are the future cash flows. Future cash flows. From which date? From after 31st December 2011. So future cash flows are interest 1,500 in 2012, then in 2013 1,500 plus. Is there any premium? No. It is set. The question says it will be redeemed at par, mean at face value, the 30,000. So these are the future cash flows. 1,500. So this will be the 31,500. Calculate its present value. But the discount factor, the new effective interest rate, this is the discount factor. So for 1 year it will be 1.06. Second year it will be, why I am saying this is second year, though this is third year. In fact, we are calculating at this point in time on 31st December 2011. So from this point, this is first year, this is second year. So here the par is 1, here the par is 2. When we will multiply these factors with these cash, so this will give us present value over here. When we'll add these present value, so this will be the fair value of financial liability. This will be the fair value of financial liability at 31st December 2011. So let's see the answer from there. I can take the figure. Answer for this. So this is the illustration. So the answer is basically 29. The answer is 29450. So let's go back. So this is 2 29450. So this will be the closing liability, statement of financial position value of closing liability. How much? 29450. But in fact, there is a difference. This difference will go to the profit and loss account. How much? 550. This will be 550. So we can make one entry, we can make two entry. Just please remember, because someone asked earlier about the journal entry. So I'm going to write here the journal entry of this as well. See, this is the opening balance. So its journal entry is very simple. Debit cash 30,000 you received on 1st January 2011 and credit the financial liability. Thereafter, there will be two on 31st December. So let me draw a line. I can change my color as well so that it is not mixed up with the rest of the data. This means on 31st December 2011, one entry will be for payment of cash. How much cash we paid? Cash, credit 1500, interest paid, debit, finance cost, profit and loss account. So this is the same as we did earlier, 1500. No balancing figure. Had it been there, it would have gone to the financial liability. Another entry, this is one entry on 31st December 2011. Second entry will be this difference. For this difference, because liability is reducing, so debit liability, financial liability, debit financial liability with 550 and credit profit and loss account 550. So this is entry for this. So this is the solution for this. So this is basically fair value model. This is basically the fair value model. Let's go back to our discussion. Okay, from current slide. So because at the end of first year there was a change in the effective interest rate. So this was the fair value through profit and loss. Derecognition of financial liability. So before I move to the derecognition of financial liability, I would just like to highlight one point. See, in 2012, if you go back to the same question, this is the story about 2011. And for 2012, sorry. In 2012, just go a little higher. Yes. In 2012, the opening balance will become 2012. Opening liability will become 29450. This is the opening liability. Same from here. Opening liability. This is the opening liability. Then again, this opening liability will be multiplied with the effective interest rate. But which effective interest rate? The changed one. Now the effective interest rate is 6%. So now you will multiply 29450 into 0.06%. So this will make it 1767. Cash paid remain the same because cash paid is based on the coupon rate of interest that is there. So that will be 1500. So again the closing liability, how you will calculate? Add these two figures minus 1500. This will give you the closing liability. Again calculate the fair value at the end of this year. So the difference between these two goes to the profit and loss account, and whatever effective interest rate at the year end, this will become the effective interest rate for the next year calculation. Any change in effective interest rate at the end of the year will be applicable for the determination of the finance cost for the next year. I hope this is clear. Derecognition of liability. a financial liability is derecognized when it is extinguished. I just would like to highlight one important thing. That is, there may be a substantial modification of the terms of the existing financial liability. In an earlier example, in which a bank loan was involved of 100 million, there was a modification in the terms, but that was very insignificant. Standards say if there is a substantial modification of the terms of the existing financial liability, or a part of it should be accounted for as an extinguishment of the original financial liability and the recognition of a new financial liability. So how we will define substantial? Substantial is defined where discontinued present value of the cash flows under the new terms discounted using the original effective interest rate is at least 10% different from the discounted present value of the cash flow of the original financial liability. So this will be considered as a substantial. So you will be de-recognizing already recognized financial liability and recognizing it as a new liability. So whatever difference arises, you will be recognizing that difference in the profit and loss account as we did earlier. Now comes the financial asset. Do we have any question, Mr. Bilal?
So
Quickly,
there are a lot of questions.
So please accept our excuse. We'll be answering few questions during this session, but it may not be possible to answer all the questions. But please don't mind, you can send it through email. Email is, as I mentioned in session number 1, you can send through that email, or you can, whatever you questions are being asked that are available with us, we can answer through ACC as well. No problem.
So we'll start with Tamila Hassan's question. She's asking, please put my question in the queue. Either certificates fall in primary or secondary instruments. If so, their treatment.
Which certificate?
It's just certificates.
Certificates. Yeah. So this question is not clear. Okay, next. Okay.
Tamila, can you please ask your question again? Can you please elaborate it? Next is from Ahmed Rustan. He's asking, in the second example, what if effective interest rate is different from stated interest rate?
Effective interest rate is different from?
Stated interest rate.
This could have affected our initial recognition. When face value and the amount which you received from the market is same, then effective interest rate and coupon interest rate will be the same. So if there is a difference between these two, then there will be a difference between the face value and the cash you actually received on the issuance of that liability.
Next is from Tashfeen Riaz. He's asking, how do we differentiate as to whether it is FVTPL or amortized cost if it is not mentioned in the question? Practically,
if an entity chooses that will be subsequently measuring their financial liability at fair value through profit and loss. Otherwise, or financial liability is held for trading. Except these two conditions, this will be subsequently measured at amortized cost.
Next is from Mubashir Noor. What is the value of financial asset by bank in example 3?
What is the value for?
What is the value of financial asset by bank in example 3?
Yes, for bank,
yeah.
It depends. Now we are going to discuss the financial asset. This will be a financial asset for the bank. So there are various options how it can be treated by the bank. So
next is from Muhammad Adil Yunus. If the market rate hadn't rise to 6%, rather remain at 5%, then what will be the treatment?
This means there is no change in fair value. That closing balance 30,000 will remain the 30,000. So no general entry, no effect in the profit and loss.
Fasih Khan wants you to repeat what are the impacts of changing in EIR.
Yes. If at the end of a year there is a change in effective interest rate, and we learned how to calculate the fair value of the closing liability. We did it. How we did it? We determined the future cash flows. We discounted those future cash flows using the new effective interest rate. So this gives us the fair value of the financial liability at the end of that period. Now, from this date onward, finance cost will be calculated using this new effective interest rate.
Next is from Sahar Amin. She's asking the effective interest rate in 2011 was 5%, then why we have used 6% for discounting cash flows?
So this is the method how we calculate the fair value of a financial liability. If you want to calculate the fair value of financial liability, what you will be doing, you will be discounting its future cash flows by using the current effective interest rate.
Next is from Muhammad Arif Javed. In fair value model, we need to calculate amortized cost as well as also fair value. Am I correct?
No, that you can say as we did in case of amortized cost, but in fact that is a fair value based on the previous effective interest rate, technically speaking. But apparently it is amortized cost. I mean, we stop here and we do not recalculate the fair value. So this is our amortized cost. But if we need to calculate the fair value, so there could be and there could not. Yes.
Next is from Ali Nagash. What type of instruments we can categorize as FVTPL and amortized cost? What is the difference between those instruments?
Answered.
Next is from Dulshan Tilkaratna. He's asking, how do we decide the valuation method for a financial liability? That is FVTPL or amortization method.
I mentioned it earlier, but just let me repeat. If entity chooses or financial liability is held for trading, in both these cases, fair value through profit and loss. Otherwise, amortized cost.
Next is from Salman Rafiq. What is the impact of premium for accounting financial liability?
Premium for?
What is the impact of premium for accounting financial liability?
Premium will be added to the face value at the time of redemption.
Next is from Maria Khan. She's asking, what will be the impact of changes in the effective interest rate?
If financial liability is subsequently measured at amortized cost, no effect. If financial liability is being measured using fair value through profit and loss account, of course, there will be a change in the fair value. There will be a change in the value of the liability. Let's move further. Financial assets. Financial asset. We are very sorry we have to stop you, but you can keep on sending your question. We'll be inshallah answering it either through email or either through this ACCA portal. When an entity acquires a financial asset, it will be acquiring a debt asset, for example, an investment in bonds, trade receivables. These are your debt assets, or an equity asset, for example, an investment in ordinary shares. In case of financial asset, if you have invested in the bonds, so this is your debt asset. If you have invested in the shares of some other company, this is your equity asset. So accounting treatment for debt asset. On recognitions, financial assets are classified as measured at either amortized cost, fair value through other comprehensive income, or fair value through profit and loss. So be attentive, there is a change which took place in May 2014. So far it seems there is no change, but there is a change. See, financial asset, debt asset can be classified by using either of these three methods. So the next question is, how we will decide should we use amortized cost, fair value through other comprehensive income, or fair value through profit and loss? So, a financial asset, that is debt instrument, will be subsequently accounted for using amortized cost if it meets two simple tests. These two tests are the business model test and the cash flow test. Number one, business model test is met where the purpose is to hold the asset to collect the contractual cash flows rather than to sell it prior to the maturity to realize its fair value changes. Mean you want to hold it. Business model test is you want to hold it. Let me use here a pen. I hope this time it should not hang. To collect the contractual cash flows. This is one. And cash flow test will be met when the contractual terms of the asset give rise on the specified dates to cash flows that are solely receipts of either principal or interest. This is debt asset, please. Debt asset. So if you intend to hold it, if this is the way how management actually manages the portfolio, that they hold it to the maturity. Second, cash flow test, where cash flows are only receipts of either the principal or the interest. Then that debt instrument will be accounted for using amortized cost. So this means there are two conditions. If those two conditions are satisfied, then you will be using amortized cost for debt asset. First is business model test. What it says that you will be collecting the contractual cash flows rather than to sell it prior to the maturity to realize its fair value changes. Second, attached cash flows are either principal or interest. Next is, so I think I should go back to my, again it is hanged. I think when I use this pen on this PowerPoint, so it is hanged. So please excuse us. By the time we can pop up question number 3, please answer question number 3 by the time this matter will be resolved. I think when we use this pen,
Unless I guess there might be some
again every time this.
All right, ladies and gentlemen, pop-up question number 3 comes up on your screen now. I'll read the question out. It says, in case of financial liabilities, the instrument will be initially measured at FV less issue, cause if subsequently measured at FV TPL. Yes or no?
Can you repeat the question?
In case of the financial liabilities, the instrument will be initially measured at face value less issue.
Fair value.
Fair value less issue, cause if subsequently measured at FV TPL. Three seconds left, and the time is maybe 10 more seconds. 5, 4, 3, 2, 1. I think people are still answering. 15 more seconds. I want maximum people to make an attempt. And stop. Okay, the answers you've got, and I think you'll have to come in, whoever's have to explain what the right answer was. 56% are saying yes. 44% are saying no.
44% are correct, unfortunately.
Unfortunately.
Why? Because if you measure any financial liability subsequently at fair value through profit and loss, initially it will be measured only at fair value. We will not deduct the issue cost from the fair value. I think this posed perhaps every question will be answered with yes.
But that's okay. I think there's nothing wrong in answering this.
So let's move further.
Yeah.
So financial asset.
Just a second.
Yes, please.
Hiding the.
Can we move further?
Sure.
Yes. Financial asset. A financial asset must be classified and measured at fair value through other comprehensive income. I am ignoring this for the time being. I'll be coming back to this in the coming slide. So just remember first this principle. A financial asset must be classified and measured at fair value through other comprehensive income if it meets both of the following criteria. Number one, the financial asset is held within a business model whose objective is achieved by both collecting contractual cash flows and selling financial assets. Number two, the contractual terms of the financial asset give rise on specified date to cash flows that are solely payments of principal and interest. Two is the same as we saw in case of amortized cost. Half of one is same, like this collection of contractual cash flows. This is the same. This means this one and this one. If these two hold, then you will be measuring that financial asset using amortized cost. But if the third one is also included in that, this mean they can sell the financial asset. So if it is also added in the way they manage their investment portfolio, so that asset must be, this is very important, this is new introduction, this was not there before, must be, this was introduced in May 2014, must be classified. You have no choice. If all these three conditions, one, collection of contractual cash flows and selling financial asset, and the third, payments are in the form of principal, cash is in the form of principal and interest. So then you must classify it using fair value through other comprehensive income. Later on we will be naming it mandatory fair value, mandatory classification through fair value through other comprehensive income. So please remember this. So this is the debt asset. And what about the rest? Rest will be measured at fair value through profit and loss. This means for financial asset, which are debt asset, mean bonds, account receivable, which are debt assets. The default position is fair value through profit and loss. If business model test and cash flow test both are satisfied, then amortized cost. If business model test and selling of financial asset plus cash flow test, all these three are satisfied, then you must measure it using fair value through other comprehensive income. So I think these two things are clear. So this means fair value through other comprehensive income. There are three conditions: collection of contractual cash flows, plus you can sell, you have the history or you have the policy of selling the financial asset as well, plus cash flow test, cash test. And amortized cost, if number 1 and number 2 are satisfied. But fair value through profit and loss account, except these two, that asset will be measured using fair value through profit and loss. But there is one exception. What is that exception? So let's discuss it. The exception is I think this is repeating. Even if an instrument meets the above criteria for measurement at amortized cost or fair value through other comprehensive income, IFRS 9 allows such financial asset to be designated and measured at fair value through profit and loss if doing so eliminates accounting mismatch. Mean if amortized cost, conditional, fair value through other comprehensive income, conditional. But if applying those measurement principle will result in accounting mismatch, we'll be understanding that accounting mismatch in a while, will result in accounting mismatch, then your IFRS 9 allows you can recognize those debt asset using fair value through profit and loss. So what is the example? Example is where it is appropriate to use the fair value option and thus avoid an accounting mismatch is where an entity holds a financial asset that is debt and that carries a fixed rate of interest. That asset that carries a fixed rate of interest but is then hedged with an interest rate swap that swaps the fixed rates for floating rates. The interest rate swap is a financial instrument that would be held at fair value through profit and loss. And so accordingly, the financial asset classified as debt also needs to be at fair value through profit and loss to ensure that the gains and losses arising from both instruments. How many instruments are there? One is debt asset. Other is swap. This is derivatives. So because its gains and loss will go to the profit and loss, so it is allowed that you should recognize this asset using fair value through profit and loss. But again, this is conditional. If this condition is not there, you cannot avail this exception. So this is the financial asset. So let's have an example of financial asset. Financial asset is only a mirror image of financial liability. See, financial asset of, in case of debt asset, is financial asset of this entity, but it is financial liability of another entity. So let's look at the example. An entity ABC Limited purchased a fixed year 5-year bond on 1st January 2010 at a cost of 5 million with annual interest of 5%. I hope this question should be available with you in handout number 1. Payable on 31st December annually. At the reporting date of 31st December, interest has been received as expected and the market rate of interest is now 6%. Market rate of interest is now 6%. Required. Account for the financial asset at 31st December on the basis it is classified as fair value through profit and loss account. It is classified to be measured at amortized cost on the assumption it passes the necessary test and has been properly designated at initial recognition. So let's go to the, see, I just want to highlight certain things over here before moving to the answer. So this is the 5 million. And it was issued at a cost. This means this is the face value plus this is also the amount of cash received. 5 million is received. 5 million is the face value. Both are same. Annual interest rate 5%. This is coupon rate of interest. Coupon rate of interest. Coupon rate of interest will be used to calculate the cash receipt, because this is asset here. We will be receiving the cash. And the question says 5% is also the effective interest rate. Fine, no problem. So effective interest rate changes at the end of the year. If we are using amortized cost, this change will not affect. We learned it in financial liability. This change of effective interest rate at the end of the year will not affect if this debt asset is being measured at amortized cost. This will only affect if this debt asset is being measured at fair value through profit and loss, or at fair value. So let's go to the answer. Let's go to the answer. We have answer over here. Yes, this is the question and this is the answer. Let me make small change here. So this should go to the next page so that we could see it as a whole. First I'll go to the amortized cost. See, if classified, I think everyone can see this. If classified to be measured at amortized cost, Mr. Harun, okay. This requires that the fair value, see, this requires that the fair value of the bond is measured based upon expected future cash flows, discounted at the original effective interest rate. This will continue to be at 5 million as the following calculation confirms. Simple. If I make here a schedule, just to make you understand, see, year 2011, opening asset, the way we did with liability, opening liability, that was opening liability. So, sorry, I mentioned opening asset, 5 million, because this is the amount of the cash received, 5 million. Finance income, not cost. We are discussing now financial asset, not financial liability. Finance income. Again, the same formula. Effective interest rate into this opening asset. So what is the effective interest rate? 5%. I have the calculator with me. So this 5% will become 0.25 million. 0.25 million. So let me put here dot. So cash paid, sorry, here cash received, I forgot. Cash received, because this is our asset, we will be receiving the interest. How much? Of course, coupon rate of interest is 5% and face value is also 5 million. So this will become 5 million. So the closing asset will be 5 million. 2012, 2013, 2015, same, because in case of amortized cost, effective interest rate will not change. That will remain the same, which was at the date of inception of this law, inception of this debt asset. So that's why this calculation is saying, okay, even if you try to calculate fair value at the end of first year or second year or third year, how you will be calculating? You will be seeing after 2011 what are the cash flows. That cash flows will be discounted using the same, in case of amortized cost, using the same effective interest rate. If you use the same effective interest rate, that will give you the same 5 million. So simply remember, either it is financial liability or financial asset. If you are measuring it subsequently at amortized cost, its finance cost or finance income will be calculated using the original effective interest rate. Because over the life of a financial asset or financial liability, there may be changes in the effective interest rate, because effective interest rate is based on the market interest rate. As a result of that change, there may be changes in the effective interest rate, but if you are measuring your financial asset or liability using amortized cost, this effective interest rate will not change for the purpose of calculation of the finance cost or finance income. So we have, okay, so we'll be having small break, but let me see, I should close at somewhere. So this ends the financial asset. Sorry, before going to the break, let me discuss the fair value of this so that this question is at least complete. So if this asset is being measured at fair value, see what happened. Here they have solved differently. I'll be helping you out. Like, for example, 2011, 2011, same opening asset, OA opening asset 5 million. This is 2011. This is year. This is finance income, same as we did in amortized cost. Effective interest rate into opening 0.25 million. Cash received, simply coupon rate of interest into face value. Face value is again 5 million, coupon rate of interest, so 0.25. So closing asset, but this will not go, not for statement of financial position, only for calculation purpose. So this will become 5 million. But we will calculate the fair value at this point in time, fair value of asset, financial asset. How we will calculate? We will see at this point in time, mean at 31st December 2011, what are the future cash flows? Future cash flows are in 2012, there will be 0.25 million. 2013, there will be, see, 2000, we have started from where? This is 2010. The starting year is 2010 or something else. So its life should be, let me check what is the question. Question is, at the cost of 5 million is now received as expected and the market rate of interest at 31st December. So the first year is 2010. So this is 2010. This is 2010. This is not 2011. Oh, sorry. This is 2010. So here we are at the end of 2010. So this will become 2011, as we can see here. This is 2010. This is This is 2010 cash flows, sorry, 11, this is 12, this is 13, this is 14. So this is the new effective interest rate. This is the new effective interest rate, this 6%. When we discount it using this new effective interest rate, so this will make it 4.8267. So the difference between 5 million and 4.8267, this much will be sent to the profit and loss. So now we can take a break for Asr prayer. So we'll be coming back for 5 to 10 minutes. Of course, maybe some people may have to make ablution. Thank you. Please.
Thank you very much. We're going to leave the session as it is. Come back. It's the time right now is 5 o'clock exactly. So we'll resume at about 10 past 5. Thank you very much.
Muted. Unmuted.
Okay, so far we discussed financial liabilities, financial assets. Now there is a concept of compound instrument. Just I would like to remind you that there could be such instruments which are hybrid. Its example is like convertible bonds. At the redemption, you can get cash, or you can convert those bonds into a fixed number of shares. So this is the choice of the holder. So this is termed as hybrid or compound instrument. If an entity issues a financial instrument that is hybrid, for example, convertible debentures, then the holder of such instrument has the option either to convert it into fixed number of equity shares or cash at the date of redemption. I just want to highlight here how we will account for such compound instrument at initial recognition with the help of an example. So here is an important point, like should be recorded by separating the debt and equity element. So the method is very simple. First of all, you will calculate the debt portion. First of all, you will calculate the debt portion. And then the residual value will be the equity portion. Step number 1 is determine the future cash flows attached to the compound instrument, assuming cash will be paid on the redemption. Step number 2, discount these future cash flows using market rate or effective rate of interest. The debt element will be the sum of discounted balances. So this is very simple two-step approach. So let's understand it with the help of a small illustration. If an entity issues 2,000 6% convertible debenture of 1,000 each. This is the number of convertible debenture. This is the face value of each convertible debenture. So this means how much cash they received? They received, because it is issued at par. At par. They received, though it is not mentioned over here, but I am assuming that these were issued at par. So they received this much cash. So this will be debited. Now, what will be the credit? There will be two credits. One is financial liability. Financial liability or convertible debenture, whatever name you want, you can give. So, equity reserve. For equity reserve, this will be the balancing figure. This will be the balancing figure. So this means we will calculate this amount, financial liability. How we will calculate? As we learned in the previous slide, we will first see what are the future cash flows. What are the future cash flows? Future cash flows are the company will be paying 6% interest in year 1, 3 years. There are 3 years. So year 1 cash flows 6% of 2 million. So let's calculate 6% of 2 million. This will be 120,000. In year 1 cash flow outflow is 120,000. Year 2 same interest, because we learned cash is always based on the face value and the coupon rate of interest most of the time. Year 3 interest plus, here what we will do, we will assume that this will be redeemed at par. The holder will get the cash. So 2 million will have to be repaid. So these are the cash flows, year 1, year 2, year 3. We will discount it using this effective interest rate. When we will multiply using this effective interest rate, the first year will be, this will be the multiple factor, this will be the multiple factor, and year for raised to power 2, and this will be the multiple factor raised to power 3. So this will give us, I have the answer with me, this will give us 1848123. 1848123. So our entry will be cash debit 2 million, debt or financial liability or convertible debt, you can name it anyway, 1848123, this is the debt. So this will be the residual value. How we calculated it? See, 2 million minus this. So this is the residual value. So this is the concept of how we initially measure compound instruments. So let's go back to, so this was the, this was the financial assets. Okay. Now we will be discussing impairment of financial assets. So for some time, Mr. Haroon, can you help me in popping up another question? Okay, I continue by the time they are ready for popping up another question. Oh, okay, we can. Please pop up another question.
All right, if you're ready, the question comes up on your screen now. I'll read out the question. It says, financial asset can either be debt asset or an equity asset. Yes or no?
Can you repeat?
You have 1 minute for it. I'll repeat the question. Financial asset can either be debt asset or an equity asset. Yes or no? 30 seconds. 10 seconds. I'll give you about 30 seconds more because people are still answering. So 30 seconds more. Fifteen seconds left. And the time is up. Close. All right. So let me share the answers with you. 86% feel that the answer was yes. 14% feel that the answer was no.
86% were correct.
Right. Okay. Thank you very much. The correct answer.
So let me repeat.
Yes.
financial asset can be debt asset or equity asset? The answer is yes. It could be debt asset, it could be equity asset. So I think we should move further.
There are a couple of people saying they can't hear anything. Can all of you confirm if you can hear us?
Please
Type
confirm that
box
yes.
whether you can hear us. Type yes if you can hear us.
They cannot hear us. From how long?
Should be able to. Yes, yes. A bit of distortion, but that's on the...
Okay, let's move to a very complex area. Though what we did earlier was not very simple, but now we are moving into deeper and deeper sea. Impairment of financial assets in hedge accounting. So what is the difference? What was the old approach? And what is the difference between impairment methodology in the old approach and impairment methodology in the new approach? Number one, old approach was based on incurred credit losses model. And second, need for trigger event. The old model assumed that all loans would be repaid. There was until evident to the contrary. That is, until the occurrence of an event that triggers an impairment indicator. Only at this point was the impaired loan written down to a lower value. Meaning there should be an indication, as we learned in case of tangible assets, intangible assets, in International Accounting Standard 36, that there should be an indication for an impairment review to be conducted and subsequently impairment to be charged. This was the previous case. This is termed as incurred credit losses model and need for trigger event. If there is no event, no need to assess the impairment. So what was the accounting treatment? We shall understand it with the help of this example. This is available in your handout. So keep your handout in front of you, because when I will go to the answer, this question will disappear from the screen. An entity ABC Limited purchased a 5-year bond on 1st January 2010 at a cost of 5 million with annual interest of 5%, which is also the effective rate payable on 31st December annually. If in early 2011, it was identified the bond issuer was beginning to experience financial difficulties and there was doubt regarding full recovery of the amounts due to ABC Limited, an impairment review would be required. The expected future cash flow now expected by ABC Limited from the bond issuer are as follows. 31st December, year ended 31st December 2011, 0.2 million. 31st December 2012, 0.2 million. 31st December 2013, 0.2 million. And 31st December 2014, 0.2 million plus 4.4 million instead of 5 million. So these are the expected cash flows. So how impairment loss will be calculated? As per the old approach, simply 31st December 2011, this is the amount of expected cash flows. This is the amount of expected cash flows at this point in time. I hope question is in front of you. So this is the expected cash flows. This is the discount factor and this is the present value for this year, expected cash flows. then this is the expected cash flow for second year, and this is the present value for that. Similarly, these are the present value of the expected cash flows in 2013 and 2014. If we just add up all these present value, this will become 4.3290. This is termed as, let me use a pen, this is termed as recoverable amount. Recoverable amount. So what is the carrying amount? Carrying amount is of course 5 million. 5 million, and this is recoverable amount. Impairment will be the difference between these two. The difference is 4.329. It will be $0.67 $0.671 million. So this is the impairment charge. So profit and loss account will be debit, and this financial asset will be credit. So how we calculated the recoverable amount? Simple. We discounted the expected cash flow as a result of impairment. Just remember the concept of value in use concept. What we used to do, we used to estimate how much cash will be received in the future years, and that cash were discounted. Similarly, we estimated the expected cash flows in the future year, and we discounted those cash flows using the original effective interest rate. This means two things are important. Expected cash flows will be used. Expected itself relates to the future. Expected and discount rate will be original effective interest rate will be used as a discount factor. Original mean when we bought this financial asset. At that point there was an effective interest rate. So that effective interest rate will be used. So this was the old approach, very simple. Simply estimate expected cash flows and discount them by using the original effective interest rate at the time of inception. So this was the old approach. What is the new approach? The new approach is expected credit losses model. See, here is the difference, though we will be discussing it at length. So see, expected relates to the future. See here, incurred related to the past, history. Here, not only history but future as well. No need for trigger event. No need for trigger event. The new approach eliminates the need for a trigger event to recognize impairment losses. An entity will make an ongoing assessment of expected credit losses, which will be updated, and movements will be recognized at each reporting date. This will result in impairment losses being recognized earlier than under the IAS 39 incurred loss model. So these are the main two differences between the old approach and the new approach. Next is, under IFRS 9, the same impairment model applies to the following: financial assets measured at amortized cost, financial assets mandatorily measured at fair value. These are fair value through other comprehensive income, which I mentioned earlier, that if three things are there: number one, Business model, collection of contractual cash flows, plus selling of financial asset plus cash flow test. If all these three things are there, so then it is must that you should measure that debt asset using fair value through other comprehensive income, with one exception. And that exception is when this will result in the accounting mismatch. If this will not result in the accounting mismatch, then there is no other exception you will have. So that's why here mandatorily word is used. Loan commitments, financial guarantee contracts, lease receivables, and contract assets within the scope of IFRS 15. Same model, same impairment model will be applicable. Whatever we will discuss in a bit, that will be applicable to all these financial assets. Expected credit loss model. Expected credit losses are defined as the expected shortfall in contractual cash flows. The estimation of expected credit losses should consider past events, current conditions, and reasonable and supportable forecasts. So let's understand with the help of an example. Before going to the example, so far anybody has any question, but I would like that questions should be restricted only to the impairment of financial asset. Number one. Number two, till the point, to the concept we discussed. Yes.
I'm sure there are many questions on the way now. There's one question at the moment, which is, is it possible to do an example under new model for implementation?
Of course, we'll be doing
okay.
2-3 examples. We'll be discussing with the help of that.
Now, right? Or afterwards?
After a while.
All right. Okay. So in today's session?
Yes.
All right. So I think that's about it. There are a few people who are facing an audio issue, but the rest is fine.
Okay. Okay, this is basically a three-stage approach. Stage 1. At initial recognition, an entity shall estimate the cash flows expected by considering all contractual terms of the financial instrument and estimating reliably the expected life of the financial instrument compared with the cash flows it expects to receive. Right now, when you are going to measure a financial asset, at this point in time, you are required to think what you expect you will receive in the future. If the credit risk of the financial asset is assessed to have, so if on the initial recognition there is low credit risk, then we will term it as stage 1. Maybe after initial recognition there is still low credit risk. Subsequently, we will term it as stage 1. But if credit risk increases significantly, this will become stage 2 in the model. There are 3 stages in the model. If there is low credit risk on initial recognition or subsequently, this will be termed as a stage 1 in the model. And if there are significant increases in the credit risk after initial recognition, this will be termed as stage 2 in the model. And if there is an objective evidence of impairment at the reporting date, then this asset will be termed as in the stage 3 of the model. If the credit risk of a financial asset increases further to a point where it is considered to be credit impaired, it falls into stage 3 of the model. So these are the 3 stages. So let's discuss first stage 1. At initial recognition, an entity shall estimate the cash flows expected by considering all contractual terms of the financial instrument and estimating reliably the expected life of the financial instrument compared with the cash flows it expects to receive. If at initial recognition the cash flows it expects to receive are less than those in the contractual terms, then 12 months expected credit losses are recognized immediately in the profit or loss and deducted from the carrying amount of the financial instrument by way of a loss allowance account in the statement of financial position. So if at initial recognition you expect a low credit risk. Low credit risk means you expect a lower amount of cash than is contractually agreed. I will repeat. If you expect a lower amount than contractually agreed, but that amount is not significant, so that financial asset will be in stage 1 of the model. How much loss will be recognized? Equal to the 12 months expected credit losses. The entry will be debit, profit and loss account, and credit loss allowance account with this amount. So this is stage 1. From this slide, we only need to remember 2 things. One, if at initial recognition or subsequently there is a low credit risk, not significant credit risk, low credit risk, then this will be termed as stage 1 in model. So how much loss will be recognized? Equal to the 12 months expected credit loss. You will be calculating this. We will be discussing how this will be calculated with the help of an example, and that amount will be debited to the profit and loss account and credit to the loss allowance account. But in the statement of financial position, that financial asset will be presented after deducting the balance in the loss allowance account. So this will be presented in the financial statement. Financial asset will be presented in the statement of financial position after deducting any balance in the loss allowance account. So this is stage 1. So at each reporting date, the financial asset credit risk will be assessed because there is no need of any trigger. If there is no significant increase in the credit risk, since initial recognition or the financial asset is deemed to be low credit risk, it remains in stage 1 of the model. 12-month expected credit losses shall be recognized at the reporting date. Stage 2, when there is a significant increase in the credit risk, so you will be recognizing lifetime expected credit losses. If the credit risk of the financial asset is assessed to have increased significantly, increased risk of default since initial recognition, it enters stage 2 of the model. This stage recognizes full lifetime expected credit losses, that is an expected present value measure of credit losses that arise if a borrower defaults on their obligation throughout the life of a financial instrument. They are the weighted average credit losses with the respective probabilities of default as the weights. There is a rebuttable presumption that the credit loss on a financial asset has increased significantly since initial recognition when contractual payments are more than 30 days past due. However, an entity cannot solely rely on the past due information and should also assess reasonable forward-looking information, as in stage 1, the movement in expected credit losses is recognized in the profit and loss and through the loss allowance account in the statement of financial position. So simply, again, if subsequently credit risk increases, so this will become stage 1 in the model, stage 2 in the model, and you will calculate total full lifetime expected credit losses. The entry will remain the same: debit, profit and loss account with this amount, and credit loss allowance account with the same amount. And in the statement of financial position, you will present financial asset after deducting the balance in the loss allowance account. So this is stage 2. Now we move to stage 3. If there is an objective evidence that there is a significant deterioration, that there is a significant increase in the credit risk, then again you will recognize lifetime expected credit losses. Apparently it seems there is no difference between stage 2 and stage 3. Yes, you are very right, so far as the credit losses recognized are concerned, but there is a difference which will be explained in a while. So, how we will calculate expected credit losses? Let's define lifetime expected credit losses. This is an expected present value measure of credit losses that arise if a borrower defaults on their obligation throughout the life of a financial instrument. See, the bail company has a portfolio of $50,000 financial asset, debt instrument that have 2 years to maturity. And are correctly accounted for at amortized cost. Each asset has a coupon rate of interest 10% as well as an effective rate of interest 10%. No previous impairment loss has been recognized. At the year-end, information has emerged that the sector in which the borrowers operate is experiencing tough economic conditions. It is now felt that a proportion of loans will default over the remaining loan period. After considering a range of possible outcomes, the overall rate of return from the portfolio is expected to be approximately 6% per annum for each of the next 2 years. So this is the end of the first year. So how much in the future you expect? 6%, approximately 6% return you expect. Required, calculate the expected credit loss on the lifetime basis. If we just recall, if we just go back instead of recalling, if we just what is expected credit losses? Expected credit losses are expected shortfall in contractual cash flows. Expected shortfall in contractual cash flows. Please remember this. Expected shortfall in contractual cash flows. Expected shortfalls. See, what is the solution? Solution is, in year 1, 2000 is the expected cash shortfall. What was the expectation? expectation was 10%, mean you are expecting that you will receive 5,000, 10% of 50,000. But portfolio is expected to be approximately 6%, mean you will be receiving 6%, mean you will be receiving 3,000 instead of 5,000. You will be receiving, let me use here a pen just to mention this is the key point. If you understand it, this means you understand the whole concept. Originally, you were to receive 5,000 per annum based on 10% of 50,000. As a result of impairment, as a result of this change, you will only be receiving 6% of this 50,000. So which is 3,000 per annum. So what is the loss? Expected cash loss. How much? It is 2,000 per annum. So here in year 1, 2,000 is the expected cash loss. So this is the discount factor. This is present value. Year 2. So this is the amount. So this is the lifetime expected credit losses. Lifetime expected, it's not doubt, it's comma, lifetime expected credit losses. Just go back to this. You have an asset, 50,000, original interest rate was 10% and you are receiving every year 5,000. Every year you are receiving okay, let's use another. Every year you are receiving this 5,000. Because of change in the because of this problem, now you will be receiving only 3,000, 6% of 6% instead of 10%. So your cash loss per annum is 2,000. So what we did, we used this 2,000. This is contractual cash flow shortfall for the calculation of lifetime expected credit losses. So this is lifetime expected credit losses. Then is 12-month. How will we calculate 12-month expected credit losses? An entity calculates 12-month expected credit losses by multiplying the probability of default. See, this is very important. Probability of default occurring in the next 12 months by the total lifetime expected credit losses. So just we calculated lifetime expected credit losses, how much? 3471. So 3471. So this is 3471. What is this? This is lifetime expected credit loss. If we want to calculate this 12 months expected credit loss, what we will do, we will multiply this figure. We will multiply this figure with probability of, see, let's change the color. Probability of default occurring in the next 12 months. Maybe it is say 5%. So this means this will become 12-month expected credit loss. This will become 3471 into 0.5%. So this will become 173. If it is stage 2 or 3, the entry will be debit profit and loss account with this amount 3471, credit loss allowance account with 3471, and the asset should be reduced by this amount while presenting that asset in the statement of financial position. If it falls in stage 1, then debit will be 173, credit will be loss allowance account. And similarly, that asset, we will reduce that asset by 173 while presenting that asset in the statement of financial position. So let's have another example. 12 months expected. Entity A originates a 10-year amortizing loan for 1 million. Entity A estimates that the loan at initial recognition, it should be loan. So put here L. The loan at the initial recognition has a probability of default of 0.5%. At the reporting date, entity A determines that there was no significant increase in credit risk since initial recognition. Entity A determines that 25% of the gross carrying amount will be lost if the loan defaults. So here we are ignoring time value of money. So lifetime expected credit loss is equal to 25% of 1 million. So this will become 0.25 million. So if we want to calculate 12 months expected credit losses, simply we will multiply 0.5% with this 0.25. So the answer will be calculate the expected credit losses on a 12-month basis. The answer will be at the reporting date, the loss allowance of the 12-month, please remove this R, the 12 months expected credit loss is 1250, which is calculated. This is the lifetime expected credit loss, and this is the probability of default in next 12 months. So I expect questions. So is there any question related to the impairment?
There are a few questions. Okay. There was one question about how to determine probability.
Probability?
Yeah.
So, which average of possible outcomes?
Probability of default.
Yes. Default.
Yeah.
So probability of default. This is the this is based on possible outcomes, and normally it is based on the historical data. But if historical data is not available, then even you can use future expectations.
There's 3 questions about determining probability. There is one question by Dilshan about if an investment is made in ordinary shares of a company, that is parent in a subsidiary in the same group, and if the company is making continuous losses adversely affecting the net assets of the company, how will the impairment loss be identified?
See, this is specific question, because this is impairment is a new concept.
Right.
And my target is in this session just to communicate the basics of this new concept. This was introduced recently, just to tell you the basics of. If you have any specific scenario-based query, so please send it through email. I would recommend send it through email, because during last session I answered a couple of emails based on specific scenarios. So please.
So even if when we are answering questions in the log, they will be brief answers. But if you really want a detailed explanation, it's best to send it through an email.
Actually, in last session, someone asked about some construction projects in Dubai, and some other related things. He gave me the full detail. Then what I did, I wrote my answer with reference to the standard within that email by changing the color of my write-up. So then he answered, he was satisfied, he was clear on that. So something which is very specific or very particular, because so many people are listening, they may not be able to appreciate what they asked for. And I started explaining maybe for 5 minutes. That gentleman may be satisfied, but that will not be beneficial for the rest of the.
There's one more question, and that's about. It's very. Somebody is asking if it will be possible for us to do IAS 12 today. So is there enough time there? So about 5 minutes left. So what do you suggest?
No, I would suggest.
There are two options.
Yes.
One, that we continue till about 6:15 or 6:30 and try to finish it today, or otherwise we go to a third session for IAS 12. We thought about 2, but probably since it's succeeding, we go.
Any case, I'll be taking maybe 5-10 minutes more. Because
even if we don't do IAS 12, it still will take
5 minutes. Even hatching will not be completed today, though that will not take much time.
Okay.
But that cannot be completed within, because that is again a technical area. With this mind, we cannot start that. But with this topic, I may need 5 to 10 minutes, because after finishing, I want to answer maximum number of questions. Maximum number of questions, maybe in the next 10 to 15 minutes. So whosoever has asked a question, I'll try.
I'll thousands of them.
Okay, I'll try maybe for 5 minutes just to satisfy me. Okay, I have answered some.
All right, there's another suggestion, by the way.
Okay.
There are people who are saying, why don't we also do fair value measurement, IFRS 13? So can we not combine IAS 12, IFRS 13 and do another session next Friday?
We can, no problem. We can, no problem. We can.
People are also saying that we have other commitments, don't extend the time.
No. Okay, we will be extending maybe for 5 minutes. Please excuse us for 5 minutes, because we are sitting right from 3 o'clock.
Can we do a pop question now also?
There is no pop question. We have?
Yes.
Yes, please, pop up. So that meanwhile we can think the strategy ahead.
All right, ladies and gentlemen, the pop-up question appearing on your screen now. I'll read the question out. It says, debt element is a residual portion in the compound/hybrid instrument. Yes or no? You've got 1 minute for this. I'll repeat the question. Debt element is a residual portion in the compound/hybrid instrument. 30 seconds left. Please quickly answer the question. Fifteen seconds. And 1 second, close. All right. You'll be surprised. 36% say yes, and about 64% say no.
64% are correct. So thanks God I'm not surprised. But anyway, 36% is a big number.
It's a big number, exactly.
So I was expecting maybe you want to say 36% says no. So that is something bad.
Yeah.
So please just let me repeat this concept. This concept is, in hybrid instrument, equity element is the residual portion. Debt element is not the residual portion. Equity element is the residual portion. You determine the debt element and you deduct that element from the cash received. The residual value is the equity portion. So, impairment. In impairment, we learned how to calculate expected credit losses. Not only lifetime expected credit losses, but also the 12 months expected credit losses. So now, let's move further, because this is the impairment of a financial asset. So we know every year we calculate finance income on that financial asset. So here is a guideline. If your financial asset falls in stage 1, then you will be calculating the finance income based on the effective interest rate, or simply by multiplying the gross carrying amount of that financial asset with the effective interest rate. If your financial asset is in stage 2, then financial income will be determined by multiplying the gross carrying amount with the effective interest rate. When I say gross carrying amount, this means without deducting loss allowance account. Without deducting loss allowance account. But if your asset falls in stage 3, then the finance income will be calculated on the net basis. Mean you will be deducting loss allowance account from the financial asset gross carrying amount to calculate the net amount. That net amount will be multiplied with the effective interest rate. So here is a difference between stage 2 and stage 3. I hope this should clear.
Yes, and Sikandar Usmani says that, this unexpected 36% indicates that the retention span is over.
So only 2-3 small slides are left. So allow me to finish it. So I will not take much time because this will finish our one concept. There is a simplified approach for trade and lease receivable. For trade receivables that do not have an IFRS financing element, the loss allowance is measured at the lifetime expected credit losses from initial recognition that do not have an IFRS financing element. So initially you will measure it. For other trade receivables, mean those which have financing element, and for lease receivable, the entity can choose as a separate accounting policy for trade receivable and for lease receivable to apply the 3-stage approach or to recognize an allowance for lifetime expected credit losses from initial recognition. Mean for these, you have the choice. You can apply this approach, you can apply that 3-stage model. Then is loss allowance account. I just want to highlight certain points just to repeat them. An impairment loss shall be recognized in the profit and loss, and a loss allowance account recognized against the carrying amount of the financial asset, unless it is measured at fair value through other comprehensive income, in which case the impairment losses are recognized in the profit and loss, and the loss allowance account is shown in other comprehensive income along with any fair value movement in the financial asset. However, for loan commitments and financial guarantee contracts, the loss allowance account is recognized as a provision. The standard requires an entity to disclose the information about the change in the loss allowance account for financial assets separately from those for loan commitments and financial. For loan commitments and financial guarantee contracts, in the statement of financial position, you will be separately showing the asset as well as the related provision. That is a contra asset. Purchasing or originating a credit impaired, if you purchased or originated a credit impaired financial asset. So credit loss will be recognized lifetime expected basis right on the initial recognition. So thank you very much. If you have any questions so far. So let's see the last slide, possible effect of new model. Earlier recognition of credit losses, because this is based on the future. Before it was only incurred losses. No, these are expected losses. More judgment involved. As you questioned how we will calculate the default probability. So you will have to do the judgments. Implementing new model will be costly, of course. This need a consultant to implement in your company if your financial statements have many financial instruments and many financial assets. Especially for insurance banking companies, they need a consultant to guide them so far as this new approach is concerned. hedging. So hedging, and I think we have just taken 4 minutes. Thank you very much for these 4 minutes. And inshallah, in next session, next Friday, I think over to Mr. Haroon. He will be disclosing whatever he wants to disclose in this regard. Rather, I should say decide.
Well, I think it's a joint agreement, and the decision is that I think we would do IAS 12 and IFRS 13 in the next session, provided that IFRS 13 can be adequately covered.
Manageable. It is manageable. It is manageable because that is more or less theoretical. Very small calculation is involved.
Okay.
Main time-consuming standard will be IAS 12, and hedging will. I'll try. It should not take more than 30 minutes. So roughly, I think 1 hour and 30 minutes should be allocated to the IAS 12, and then half an hour for ISA 13.
Perfectly all right. So
this is not standard. That depends in how people are responding.
Fine. So what we will do is we will send them an invite on Monday again for the session to take place same time on Friday.
Okay.
I think one last thing. A lot of people are asking what happened to our Vimeo channel. There are some technical difficulties with the Vimeo channel which our marketing team is trying to sort out. What we are doing is, in the meanwhile, we are setting up a parallel and alternate YouTube channel also. And inshallah, it will be up and running on Monday. And on Monday, while I'm sharing the slides and the resources, other resources with you, I will also share the new YouTube link with you where the recording of these sessions will be available. I think that's all from the newsroom till now, till next Friday. So, and Pakistan has lost the match in any case, so there's nothing more to look out for after the session. So enjoy your weekend and see you all on next Friday. Thank you all.
Thank you very much. Thank you. Thank you very much. क्या था जी नंबर?
Muted.
जी बाबू, अल्हम्दुलिल्लाह हो गया सेशन.
And webinar for all.
अल्हम्दुलिल्लाह.